Well, welcome to the Armchair Trader podcast. And this week we're talking alternative energy again, but having a look at a slightly different perspective, i.e., that of a fund management outfit that is active in the space. And we're talking to a member of NextEnergy Capital, who's going to be giving us a little bit more perspective on that market and on one of their listed investment trusts as well. Today we'd like to welcome Ross Grier from NextEnergy Capital. He's a managing director there. Welcome to the show, Ross.
Thanks, Stuart. Nice to be here.
So just to kick off, NextEnergy Capital, can you give us a brief summary of the firm and what it does?
Absolutely. So NextEnergy Capital is a mission-driven organization that is trying to deliver a more sustainable future through the adoption of renewable energy. So what we really focused on is commercializing and large-scale adopting solar and ancillary technologies in multiple markets across the world. I look after the UK market for NextEnergy Capital, so predominantly focus on the activities that we've got in the UK space. There's three pillars to NextEnergy Capital. So we do everything from development, so concepting a project, taking it through its planning process, right the way through to the asset management side of our vehicle, where we long-term look after and extract value from these assets for our investor base. And in the middle of all of that is what's called NextEnergy Capital, which is the investment management vehicle that looks after our funds. And in this particular example, we're going to talk about NextEnergy Solar Fund today. That's a listed vehicle which NextEnergy Capital has managed from its inception back in 2014.
But you, as a firm, you're obviously managing multiple funds. I presume some of them closed-ended as well.
Yeah, correct. So we've got a combination of NextEnergy Solar Fund, which is our publicly listed vehicle, and then we have a whole suite of private vehicles. Again, they're all renewables focused. So we tend to do solar at the core of everything we do, and then ancillary technologies, and that's everything from battery storage to other ancillary technologies that are complementary with solar PV portfolios.
Can you say why solar? I mean, why focus on solar specifically rather than, because there's obviously, there's wind, there's experimental wave power. What was it about solar especially?
Yeah, so there's a couple of real drivers behind that. The first one is we don't believe it's possible to be expert in everything. So, we see a lot of our peers who buy everything that you've just mentioned from, AD and anaerobic digestion right the way through to solar PV and everything in between. We don't believe as an infrastructure investor that you really can extract value long term in the way that our investor base want us to from an infrastructure investment, sorry. So that's one of the core reasons, and part of that group that I detailed out at the start of the conversation is our asset management function, and we look after assets all over the world for a variety of different sponsors and lenders in varying different ages. So what we get to see in that space is how assets and portfolios are going to evolve over time, and we can feed that right back across our business, all the way back, in fact, to how we develop and construct those assets in the first instance. That gives us a higher standard of asset, more availability, more opportunities to generate revenues for our investor base, and a more robust portfolio that delivers attractive returns out into the future. So we have that at the core. Also, solar PV as well is super predictable, right? It's demonstrated over the last decade that it's a really important part of the energy mix globally, and it's going to be a really important part of how we achieve things like net zero and energy security out into the future. So we really like how deliverable solar PV is and how well understood it is as a generating set. And the combination of all of that, we think, gives us as a firm the opportunity to give outstanding returns over the long term for our investors from our platforms.
So NextEnergy Solar Fund, this is a UK listed fund. Can you tell us a bit more about this particular fund in your lineup?
Yeah, absolutely. So the NextEnergy Solar Fund was listed back in 2014. It's a FTSE listed vehicle. It recently re-entered the 250. And it was predominantly established to look at UK subsidised solar assets. So historically, the UK solar sector benefited from renewable obligation certificates and feed-in tariffs, so government-based subsidies to promote the adoption of renewable energy more widely. And we've built a significant platform of assets in the UK and other markets, which I'm sure we'll touch on later, within that NextEnergy Solar Fund platform. And it's a long-term holder of those assets. So it's looking at anything from 25 to 50-year ownership of each one of those assets. And the benefits that we bring to that platform as a team are, again, that we cover everything from how that asset is developed right the way through to how we trade the power that those assets produce and how we de-risk them operationally and so on throughout their operational life. We've got 100 assets under management at the moment in that portfolio, and we have recently brought a whole load of diversification into the platform alongside solar, which is predominantly the core of the portfolio. And we've brought in some international solar PV into that mix. We've also moved quite heavily into the battery storage space as well, which is an important part of how the renewables mix continues to grow in the UK space and internationally as well. So what's really exciting from my perspective about the NextEnergy Solar Fund is it's year on year outperformed its forecasts from an operational power production expectation perspective and also from a revenue perspective. We year on year increase the dividend, and we've been an exceptionally high paying or high yielding outfit from that perspective. NAV drivers have been significantly positive of late for our sector. And we are really well kind of positioned for a high inflationary environment within that portfolio. And as well as that, existing core of a portfolio to deliver those exceptional returns, we've also got really exciting growth prospects as well through secured pipeline that we have across all of those things I've mentioned, from domestic solar PV growth, which we do at utility scale, right the way through to the battery storage side as well.
A lot of questions raised there.
Sure.
First of which is, when you're talking about the assets in the portfolio, are you primarily getting involved at the level where there's the solar farm is being planned out and scoped out, or are you buying solar farms off other people instead? I mean, how does it work in practice?
So the model's evolved over the years since inception of the fund. Traditionally, all of our peers as well were in the secondary market space. So we were buying operational solar PV assets. That was generally done at what's called PAC. So just after construction, as you've debugged the asset and it started to perform in line with expectations, you're going through a DD process and you're acquiring the asset then. What was clear from that process, though, is it doesn't give us maximum control over the way in which the asset's deployed, and that's from technology specification right the way through to how you manage quality assurance throughout the build program. So we spent a lot more time vertically integrating with that supply chain. So we now do everything from concepting the asset, finding the assets, finding the grid connections in the development stage, taking them through that planning process, and then on into the construction process, and then on into long-term operations. And what that really allows us to do is know every single blade of grass on the assets. And that's important to how we extract that long-term availability. So that long-term reliability of performance from the asset that gives us the maximum opportunity to generate revenue. And it's a key component of how we built NESF differentially from our peers. So early in the fund's life, rather than just continuing to buy secondary market assets, what we would do instead is split our acquisition. So we would exchange contracts to buy, similar to what you do with a house prior to construction, but we would complete afterwards. And that would allow us to influence the construction contracts and also the technology that was specified, so we could minimize technology risk across the portfolio, maximize the quality processes throughout. And that really has demonstrated brought to bear, the benefits of the team's knowledge in running assets into the construction process that gives us that year on year outperformance that I mentioned earlier on in our chat. And that's important to how we continue to grow the platform. So that same discipline that we applied day one applies to how we continue to grow the platform today.
And you mentioned the fact that you actually benefit from the income from the solar farm. So as electricity prices have gone up, um, your farms are actually selling power into the grid and making money. Um, does that mean that the fund actually has quite a decent yield profile from an investor's perspective for someone who's now investing in, as you say, a high inflationary environment? You're talking here about a fund that, as it acquires more and more assets, is going to be paying out more and more from its income.
Yeah, so I think couple of things important when considering why this type of a fund is really interesting in the space. So it generates its revenue from two key sources. One is those long-term government subsidies that I mentioned earlier. That equates to about 50% of the revenue that the platform generates. What's important about those is they are directly RPI linked. And they are long term. So you're talking between 15 and 20 years, depending on when that incentive was achieved. So that's 50% of the revenue stack. The other 50% comes from selling the power into the grid, as you're saying. And at NextEnergy, we have an in-house power sales desk. So we're pretty unique in the space by having that skill set within our investment team. And what they're doing is looking at how we can achieve the maximum price for the power that we're generating whilst de-risking for our investor base as well. So what we don't think our job is as infrastructure investors is to let all of this power spill into the grid, and then we take whatever the spot price is. And you can do some super lucrative trading when markets are as volatile as they are at the moment. We believe that the right thing for us to do is to forward sell that power. And that allows us to cope with any significant volatility in the market and still get really good comfort about how we're going to service that dividend out into the future. So we do a combination of both of those things to bring attractive returns into the market. We're also pretty conservative about how we value the portfolio and how we think about things like discount rates within the portfolio. So even in a higher interest rate environment, we still have cushion within that discount rate to cope with the interest rate rises. We're obviously significantly well cushioned against the higher inflationary environment with that direct linkage from the subsidies, but also the indirect linkage from the power markets. And therefore, the platform it performs exceptionally well in a higher inflationary environment. The other thing that I always like to sort of leave as a headline is what we do when we think about paying our dividend out into the future is assume no incremental growth. So what we don't need to do as a business is continue to buy assets to achieve the results that we're looking to achieve for our investors. We're able to do that from our existing portfolio. And I think that's a really interesting, again, dimension to how investors should be thinking about the current market dynamics that we're in, because what we're not doing is relying on new construction assets or new development assets that may be subject to volatility because of that same inflationary environment. Actually, we're able to do the day job from what we've already bought within the fund.
And predominantly a UK focused strategy, but you have some exposure to Italy as well. Why the Italian angle?
We started in the UK and have focused predominantly in the UK market. So the vast majority of our assets are UK based. As the sector has matured, our investors have got more comfortable with bringing diversification into the platform, and we've done that in a couple of key ways. We brought an Italian portfolio back in 2017, a market that we know really well. We actually have an office out in Milan and have done quite a lot of investing in the Italian market. So it made a lot of sense, and that's same technology set, same disciplines applied to a different market. The diversification geographically is beneficial for the portfolio, but also from an energy market perspective is beneficial as well. So we are always looking at opportunities to bring accretive projects into the portfolio that are international as well. So throughout this last year as well, we've also brought in co-investment projects with one of our other international funds in Spain and also in Portugal as well. So we continue to look at how we can integrate other markets within the portfolio as well. And the other side of diversification that I've mentioned as well is obviously on the battery storage side as well. So as you see renewable energy penetration increasing across the grid, and current market dynamics, you see significant volatility in that power price, which is where, as we know, batteries make a significant amount of their revenue long term. We don't see that volatility reducing in power pricing. We see it increasing. We like to see more renewables, and the two go really hand in hand. So it's an important part of the growth story for any fund in this space that you continue to invest heavily in that enabling battery storage technology to support that incremental growth and to give comfort to the end consumer around how the grids are being managed and grown and how that power price is being stabilized over the long term as well.
If you're looking at solar energy, how does that stack up against the other competitors in the sector, like as I say, wind power? You've mentioned anaerobic digestion on this as well. From an investor's perspective rather than the consumer's perspective, how do solar farms measure up in terms of profitability against the alternative?
So it's a very polite way of asking me if it's sunny enough in the UK, I think, isn't it? I mean, I've spent a decade answering exactly that question to investors, and it is a valid question. But actually, what we see from operations like the UK and Germany and other sort of bands in the northern hemisphere, that what you want is a combination of stable temperatures and reliable irradiance sunlight levels combined with some rainfall to also additionally clean your modules and so on. So actually the band across the UK and Germany is an exceptional place to generate reliable returns from solar. What you don't want is extremes of temperature, because that gives you operational issues, especially on the heat side, because modules become less efficient the hotter they get, and also inverters are strained more. So your key components are under a lot more stress in those higher radiance environments. So there's always a trade-off for having significantly sunnier areas. So the business case has evolved to be exceptionally reliable in the UK environment, and it's one of the reasons why, going back to the start of this conversation, why we focus on solar PV. So really low inter-year volatility in how much irradiance falls in a specific location in the UK. And as you can imagine, we monitor this exceptionally closely, and we base all of our assumptions on a long-term data set. So when we're buying an asset, we're thinking about, how has irradiance evolved over the last 25 or 30 years in that space, and how is it anticipated to evolve in the future. So we're able to predict the outcomes from these solar farms exceptionally well. And I think that's the core of where you start to think about the investing in something like NESF, which is quite heavily UK focused. We also are in a pretty stable regulatory environment in the UK. It is rare that the UK government has done anything in the past to upset infrastructure investment. They understand the importance of stability in this space in order to not discourage future investment. Obviously, the last couple of weeks have been particularly interesting as we've had new PM and so on come to the space and create a lot of volatility. But we still see from our lobbying that they are extremely dedicated to continuing to grow renewable capacity out into the future in the UK. So again, that core we expect to maintain of support from the government over the long term. Then pair all of that with operational excellence on our side as well. So we run a significant portfolio, as we've said, of assets both in the UK and internationally, that allows us to give really stable operations and generate the maximum returns. And following that, we then are using our in-house energy sales desk to generate as much revenue as we can from each of the assets. So long story short, it's extremely stable technology, and we're able to generate maximum returns reliably for investors. Now, how that stacks up against peer technologies is it has much fewer moving parts, much less complex supply chains, much less complex operational and maintenance regimes, and so on. So it's a key part of that stability in the UK energy mix. One of the other things as well that's important within our sector is it's an exceptionally well liked technology. So relative again to peers, such as onshore wind, solar PV is much more readily adopted by the masses. So you're always seeing a whole lot of NIMBYism around onshore wind. You don't really get that for solar PV. It happens in isolation, but what we like to say is the correctly selected sites with the right community engagement gets you the right results. And actually what we see from market analysis is people becoming more comfortable with solar the longer it's in place. So the longer they live near it, the more comfortable they are that it's part of the landscape and is inoffensive. And also it's really tried and tested in terms of its technology set as well. So earliest solar PV modules were installed back in the 70s and 80s and are still generating power. So there's an awful lot of that the experience that has been brought into the sector and continues to drive successful outcomes for investors and decent yields for investors, whereas other technology sets that we see coming to the space aren't necessarily so tried and tested, but are still being called an infrastructure investment as well. So it's a combination of all of that, and solar stacks up exceptionally well against all of its peers.
And we've obviously seen very high energy prices since the Russian invasion of Ukraine. Gas prices up, oil prices up, electricity prices up. A lot of governments, including the UK government, are exploring how to wean themselves off Russian gas and how they're going to cope with these higher prices. Is this a real growth opportunity for the solar power sector, particularly in the UK?
Yeah, definitely is. Solar PV has already established itself as an important part of the energy mix, as we've said. It is one of the only technologies that can deploy at scale quickly enough to bring about price stability and also those decarbonisation goals that we've got out to net zero. So we really back solar PV in this space, combined also with the battery storage that we've mentioned as well. So what's not going to happen is solar PV is going away, right? We've now crossed that threshold, and what we see is as a significant amount of investment opportunity, which makes a whole bunch of sense in the space. What we are, of course, lobbying around, and what we don't want to see is knee jerk reaction now by the government that deters any of that future investment into the future or redirects capital in the wrong way. So, it's important to us that we maintain that stable regulatory environment, and that we continue to be clear around the fact that solar PV is a very important part of the energy mix and can be for the future.
And you have already touched a little bit on the fact that, obviously we're in a high inflationary environment. Investors are looking around for the sorts of assets that can continue to perform when we're in a recession, but we're still facing high inflation. How do you think something like uh, the Next Energy Solar Fund, for example, shapes up in that kind of an environment if we're looking out over the next sort of 6 to 12 months?
Yeah, I guess I've touched on the fundamentals, as you've said. It's really well positioned to benefit from the higher inflationary environment, and the fact that we're not reliant on new assets coming into the platform is key in that space as well, because we can continue to do what we want to do for our investors without deploying new projects. As an M&A junkie, I always like to see that pipeline growing, and it looks exceptionally good at the moment. But actually, when I look at the core of why NESF is a good place to be, it's because of that portfolio that we've built to date. That's not to say there aren't of course challenges in that space from a continuing to manage OpEx, continuing to bring components into the country in a reliable fashion to maintain your assets. All of that stuff that's being experienced throughout the wider market, of course we do. But again, we've built resilience through operating perfectly through COVID and also through Brexit and various other challenges that have actually already impacted our supply chain, bring about the same sort of levels of volatility that we will experience in higher inflationary environment as well within the supply chain. So we're already robust in that regard. So I feel pretty comfortable operationally where we need to be to benefit from that higher inflationary environment. There's obviously talk at the moment of the government looking at ways in which it can short-term suppress power pricing, and we're obviously cognizant of how that market's going to evolve and the impact that has. But the core of the portfolio's revenue comes from those long-term subsidies. So really, that's that direct inflationary link there is a very secure alternative to other products that are out there, other more high risk infrastructure investments that people might be looking at.
Just finally, I go to quite a few sort of fund management conferences, and one of the big themes is obviously ESG investing. And there's frequently a debate about, oh, if you invest in funds that have a lot of ESG or impact characteristics, you'll give up some of your upside potential. Um, it's almost like a sort of a indirect green tax. But there, I think they're probably talking a little bit about fund managers in the equity space who are screening their funds. Would you say that something like NESF, I mean, it's arguably one of the better performing investment trusts in the UK universe at the moment? Would you say that's actually the poster boy for how green investment can actually work for you?
Yeah, I would absolutely say the best way to go and look at this is to go and dive into the details of the fund. So we try to be as transparent as possible with how we value the fund, what the fundamentals are of how we generate our returns and so on. So please do head over to the websites and download a little bit of information around the fund. I always get asked the question as to whether certain government change or policy change deters capital from the green environment and redirects it back into oil and gas and so on. And we definitely don't see that, right? We've always seen that this is a reliable place to invest money, and that we want to see exceptional growth in the space, as we've said so far in the conversation. So we have no concern that capital is getting particularly diluted in any green environment relative to a traditional investment set. And actually, we see the exact opposite. So we've managed to build a significant portfolio that is year on year one of the highest dividend paying platforms out there. So current target dividend 7.52 pence, with that inflationary protection that we've already built in there. We have historically paid an RPI increasing or RPI beating increase to that dividend year on year, and we've done that since the fund's inception. We're a progressive dividend policy, but you can see that the direction of trend that we adopt as a business there. So yeah, look, I think it's maybe a bit old school, the thinking that you have to sacrifice returns to really support the green agenda. What I always advise is that people really get to know an investment manager in the space as well. So someone like NextEnergy, that mission I spoke about right at the top of the call is what we live and breathe as a business. So we genuinely believe what we're doing, and we are all here because we want to transition to a more sustainable future. We focus on one technology set because we want to be experts in that space, and we think that's how we commercialize the product, and how we give incremental returns to investors and so on. So I think, provided you're selecting the right product with the right investment manager, there's definitely no sacrifice to be made in the green space.
Fantastic. Well, thank you very much indeed, Ross, for coming on the podcast today and for spending some of your time with us. That's been really informative.
Great. Thanks for having me on.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news, and sign up to our free newsletter there.